you're thinking about buying a home in the next year or two, this video is for you. I'm going to share a few tips and tricks and information about broad strokes mortgage concepts. The goal is to make sure you're on the right track. And if you follow the advice in this video and you apply the information I share, you should have an easy time qualifying for a loan, get ahead of most of the headaches that can hold things up, create headaches, cause hassles, cause problems with getting qualified for a mortgage. Now, when you qualify for a mortgage, lenders assess three things: your income, your assets, and your credit. So I'm going to share tips in each one of those categories. And if you find any of the information useful, please like and subscribe. It really makes me happy to know you got some value out of this video, and it helps my channel grow. And please remember that I'm happy to be a resource in real life too. Reach out with questions or for help with a loan. I'm licensed to lend in all 50 states. My contact information's in the caption. So let's get rolling and start talking about income. Now, the big picture thing to know about income when you're thinking about qualifying for a mortgage, or the concepts to keep in mind, are that lenders care about two things: stability and continuance. Stability is really thinking about, hey, we're lending you a big bunch of money and you're gonna have to make payments over a period of years. So how much can we count on your income being over time? There's some types of income that are inherently stable. If you're salaried, if you work a set number of hours like clockwork always, that's super easy. That is inherently stable income. But there are other types of income that are inherently not stable and get trickier. And as a rule, what lenders are going to want to do for any income that is not like clockwork stable is we're going to average it over a period of time. The gold standard is to average it over 2 years, but we're typically going to want to average any source of variable income over at least 1 year. Now, the other concept to keep in mind is continuance. So if we use a source of income for loan qualifying purposes, you're going to have this mortgage for years, right? And we want to know that that income is going to be around. So we don't need a guarantee, but we want to be able to assume that any income that we're going to use for loan qualifying purposes will be around for an additional 3 years. And the main problem we run into is if we know a source of income is going to end inside of that period. And this would be common with, let's say, an alimony payment or child support that has an ending date. If it ends within 3 years of the day you close on your mortgage, we can't use it for loan qualifying purposes. The same thing could be true for certain sources of trust income or IRA income. We have to have that 36 months of continuance. Now, there are certain types of income that are going to live in tension with this. So if you're a freelancer or you work on contract, maybe you're a traveling RN, then what do? We don't have continuance out of any single job. If you're freelancing from job to job, you might not have 3 months, much less 3 years on one of your contracts. So what we use is we use your history, we look backwards, and we use that history of your ability to continually rustle up a new job, or as a traveling RN, get that next contract. And we want to see, including downtime and time that you're working, what's your income actually going to look like, averaged out over ideally 2 years, but at least a minimum of a year. So general rules of thumb and advice when it comes to income, and I'm going to say this over and over again, I'm sure: status quo is your friend. It's okay to change jobs if you must, but make sure that in that new job, you have a stable income that a lender can look at and know what it's going to be. If you change employment to something that isn't stable, let's say you have an hourly job, you change to, maybe it even has a set number of hours, but then, they'll let you knock off early and you don't have to work the number of hours that you're scheduled, then a lender is not going to look at that as a stable source of income, and it can't be used for loan qualifying purposes probably for at least a year. Now, if you're self-employed, that's kind of the ultimate version of income that doesn't have an automatically stable source. So lenders are going to be looking at a 1 or 2 year average, same thing as we do for other sources of income that's variable. But what's special about self-employment is that you only file an income tax return once a year. So we really get that once a year crack at establishing what your income is going to be for that 12-month period. If you've been self-employed for 5 or more years, most of the time we're only going to look at 1 year of income tax returns. If you've been self-employed for less than 5 years, or with certain types of loans, FHA, VA, and jumbo loans, we're going to look at your most recent 2 years of income tax returns. And we're going to average that in what I would call a worst case way. If your income is getting better, we're going to average 2 years of income. If your income is getting worse, we're going to average 1 year of income. And we're probably going to get some questions from the underwriter about, hey, why was your income kind of trending in a downward direction? Now, if you haven't yet filed your most recent year's income tax returns, a question I get often is, hey, should I go and file it? And if your income was better, then yeah, go file it, because we're going to have a bigger amount of loan qualifying income if you get that most recent year of income tax returns filed. But if your income was a little down in that most recent year, you may be able to sneak through underwriting with your previous year's income tax returns, not filing that most recent year and using a little higher income. Lenders only require your income tax return for most mortgages when the IRS does. So if the IRS hasn't required you to file yet, if it isn't April 15th, or if you're past April 15th, but you filed an extension and you're still okay on extension, then you might be able to get away without filing that most recent year of income tax returns. So if you're self-employed and you're an S corporation, if you've elected to set up an S corp, you are what's called a pass-through entity. All the profits from your business are going to pass through to your personal income tax return, and you're paying income taxes on them there. If you own 25% or more of that entity, we're still going to consider you self-employed, but there's a negative catch. If you don't distribute profits from your business to yourself, even though they pass through and you paid income tax returns on them, they may not count as qualifying income for your mortgage. To count as qualifying income for your mortgage, your lender is going to have to see that your business has the liquidity to have paid that money out to you. If it doesn't have the liquidity to have distributed those profits to you, then those profits aren't going to be part of your income for loan qualifying purposes. So to keep things simple, my advice to S Corp owners is to distribute profits to yourself. But for more tips and a detailed article on all the analysis that lenders do on self-employed income tax returns, check the link in the caption below. I'll put a link to an article there that I wrote a few years that gives quite a bit of additional information. Now, I'm going to offer a few don'ts, just advice as you're getting ready to prepare to apply for a mortgage. Don't start new self-employment. And remember that if you own 25% or more of a business, you are self-employed. If you're paid on a 1099, you are self-employed. Don't start working on freelance basis or on a contract basis, and don't take a job with variable hours. If you do any one of those things, you're at least a year away from a lender being able to see your income as stable and having that continuance that's required for loan qualifying purposes. Now, if you run into issues, any of these things, you didn't see this video, or you just had to start that business, there are some other options. There are some creative solutions. We can sometimes use assets as a source of qualifying income. Retirement assets, other assets, trusts, etc., can be used for loan qualifying purposes. Many mortgage loans, I would even say most mortgage loans, allow co-signers. So if you have someone who wants to help out and help you co-sign, great, we can take advantage of that. And if you're self-employed and your business has been up and running for a couple of years, there are alternative documentation options. We can use bank statements, we can use 1099 forms, profit and loss statements, all sorts of alternative documentation to show what income your business is earning without having to show your income tax returns if they're going to be problematic for loan qualifying purposes. And if you're purchasing a rental property, there are loan programs that don't even require that we document your sources of income, much less how they are. We can base a loan strictly on the cash flow for the property that you're purchasing. If the rental income is more than the mortgage payment, then there are loans called debt service coverage ratio loan programs that can allow you to qualify to purchase an investment property, even if other aspects of your loan qualifications wouldn't line up with normal loan requirements. Now, I want to shift gears and talk a little bit about assets. And the first thing that I want to say about assets is, I guess my first bit of advice is don't oversave. When first-time homebuyers, prospective first-time homebuyers are polled, there is always a substantial number of people who think that you need 20% down to purchase a property. And while they're buckling down and saving like crazy to come up with that 20% down payment, home prices are going up at a much faster rate than what they're saving, and they're falling further and further behind. So don't make this mistake. To purchase your first home, you only need 3 to 3.5 to 5% down. Even if you buy a multifamily property, manufactured home, condo, single family residences, of course. So don't oversave. Now, putting less than 20% down does mean you're going to pay mortgage insurance. But mortgage insurance is so much less expensive than most people think. I think one of the biggest surprises for a lot of first-time homebuyers I talk to is just how inexpensive mortgage insurance can be, and that it is cancelable. Mortgage insurance is temporary. It's not going to run in typical circumstances more than 3 or 4 years if you're on your toes and you have the right kind of loan and you're paying attention. I'll put a link up above here to a video that goes into the details of how you cancel mortgage insurance and has some examples with specific numbers at the end. If you have questions about that, that's an enlightening resource. As you're saving up your down payment, a great trick, and this is one I used myself when I was saving for my first home, is to divide any non-essential spending, money that could go into that kitty for your down payment, by 0.03%. The result that you get is the amount of house you could buy with that amount of money, assuming a 3% down payment. So $100 divided by 0.03 is $3,300. $100 is all you need as a down payment on $3,300 worth of house. $1,000, if you can save up $1,000 in a month, that's your down payment on $33,000 worth of house, and you only need $10,000 divided by 0.03 to cover 3% down on $330,000 worth of house. It really does add up more quickly than you would think. Now, unfortunately, although the good news is the down payment is less than most people think, closing costs, the things that you have to pay on top of the down payment, are often higher than most people think. And it's not uncommon for that set of closing costs and prepaids, the things that you pay on top of your down payment at closing, to be another 3 to 5% of the purchase price of the property. I'll put a video on closing costs up above here that breaks down some specific examples so you can kind of see what goes into all of that. But if you're tight on cash, and that sounds so discouraging because you're just trying to save up that down payment, don't let it discourage you. Sellers can contribute toward closing costs. If you can find a motivated seller, even in a hot market, there are motivated sellers out there who will contribute. I'm going to link another video up above that goes into some detail on seller concessions and the different ways that sellers can contribute to make your financing and your home purchase less expensive for you. Now, sources of down payment, things that are allowed for the down payment, are very varied, and you can get super creative with this. So first, I'm going to actually talk about the shorter list, which is the stuff that you can't use to go toward a home purchase. And it is a very short list. It's 2 things. Lenders won't let you use cash savings to go towards your down payment, and we won't let you use an unsecured loan. Essentially, we won't let you charge your down payment to a credit card, for example. Now, the reason we won't allow cash isn't that we're worried you're doing something illicit out there to earn your down payment. It's just that we have to be able to paper trail where the money came from, and we just can't document where cash came from. We are obsessed with paper trailing things so that we know that it came from an allowed source, and that whatever that source of money is, if you deposited money to your bank account or you're using it for a down payment, that it's not attached to a new debt. If you borrowed money, unsecured loans aren't allowed, but secured loans are. We just want to know what the payment is so we can take it into account in your what we call debt to income ratio as we qualify you. Now, other than those 2 things, everything is a-okay. You can get super creative. Gifts are a permissible source of down payment. Selling stuff is okay. You can sell vehicles, you can sell collectibles and art. We've got to paper trail these things. And you don't want to sell them for cash because that brings cash back into the picture. But any of that stuff is fine. You can take distributions from retirement accounts, and secured loans are okay. So you can borrow money from a retirement account. You can borrow money secured to other securities if you have a stock account. You can co-purchase with friends or family. If they want to go in on a purchase with you, whether you're going to live with them or not, a family member or friend could contribute toward the down payment. And they could co-sign on the loan, or they could just contribute the down payment and not participate in the loan at all. And if you're saving for your first home, it's really good to know about a little program that about a dozen states offer that's tax advantaged for saving up your down payment for a first home purchase. It's called a first-time homebuyer savings account, FHSA. And the video linked above here goes into more detail on that. But in certain states, you can actually get a state tax write-off for the money that you're using, the money that you're saving to go toward the purchase of your new home. Now, when it comes to assets and simplifying paperwork, unlike employment, where we're looking back a year or two, or sometimes more, when we look at assets, we're only looking at 60 days of statements. So you can simplify your paperwork and simplify the loan process by stabilizing your assets about 3 months before you apply for a loan. So if you're going to move money around, or if you're going to sell collectibles that might be tricky to document, or maybe you're a server and you've actually saved up a bunch of cash tips that we can't document, get those in the bank and stabilize everything over 3 months before you apply for the mortgage. And most of the time, other than maybe getting cash savings that you've socked away in a safe into a bank account where a lender could see it, most of the time it's just a matter of minimizing paperwork. It's not a big deal to move some money around from one source to another as long as you can handle some paperwork, but less paperwork is more better, so that stabilizing of your assets before you apply for the loan for a few months can be helpful. So last but not least, I want to talk about credit. And credit is a really tricky topic because the right thing for one person can be the wrong thing for another. Things that are really the right thing to do for 99% of people might be the wrong thing for one, and vice versa. But I want to give you a few general rules. So I'll just sort of in broad strokes say status quo is your friend. I feel like a broken record. Don't open new accounts and don't close accounts. Either one of those can negatively affect your credit score. Pay your bills on time, of course. That's kind of self-explanatory. You'd assume that. For lending purposes, on time means paid within 30 days of the due date. Make sure bills don't slip through the cracks and become collections. Now, next to all that common sense stuff, the most important factor in your credit score, besides just paying stuff on time, is what's called usage or revolving account usage. So let's say you have a credit card that has a $10,000 limit. The balance that you owe on that divided by the limit is your usage. So if you have a $5,000 balance on a $10,000 card, that's 50% credit usage. If you have any credit that is over the limit, even if it's a teeny tiny little store card with a $300 credit, $300 limit, and you owe $301, that is so horrible for your credit score. Get that down below 100% of the limit. Get it below the limit, and then work it down to 50% of the limit. And you'll notice a big bump to your credit scores. When you get everything to 50% of the limit, work everything down to 30% of the limit. And that will give you another big bump in your credit score. And that's actually a really good threshold to aim for as a rule of thumb, is keep everything at 30% of whatever that limit is or less. However, if you want to aim for extra credit, under 10% of the limit is actually the gold standard, the best place to be for maximizing your credit score. It's actually better than having a zero balance on a card. And if you're a mileage card user, I am, and you charge everything you possibly can for points, and then you pay that card off at the end of the month, you might be a little disappointed to hear that the balance that's reported to the credit bureaus is actually what they bill you. And so your high balance of the month, which is going to be the highest ratio relative to your limit, is probably what's being reported to the credit bureaus, and your credit score could be higher. I'm going to put a link to a very short video up above here that describes a little trick that is a great way for mileage card users to go ahead and keep getting all those air miles, but also maximize your credit score. Now, this is counterintuitive. If you have any negative credit and you're working on getting your credit score up for loan qualifying purposes, if you have any collections, don't pay them. This is one of the worst things you can do. If you have an old collection account that's been hanging out there and you're getting ready to buy a home and you pay that off, it's probably been dormant and not reporting to the credit bureaus, and paying it off is going to make it report to the credit bureaus more recently, which can have a very negative impact on your credit score. The only reason you should pay an old collection account, because paying an old collection account will have next to zero, if not a negative impact on your credit score. The only reason you should pay an old collection account is if you can negotiate with the collection agency to delete the account, take it off of your credit like it never existed, remove it entirely. It's called a pay for deletion. Some collection agencies will do it, others won't. Most everybody is probably monitoring their credit scores. I hope you are, and it's a great thing to do. Keep an eye on your credit score. Make sure that nothing is slipping under the radar and negatively affecting your credit, but you should know that you are not watching the right credit score. When you use NerdWallet or Credit Karma or any of the other places you can monitor your credit score for free, you're not looking at the score that we use for mortgage lending. And the score that we use for mortgage lending is going to be 5 to sometimes 25 or 30 points lower than the score that you're monitoring. That can come as a little bit of a shock when you apply for a mortgage. So if you want to know a little more about this, some kind of backstory, and where you can find out what your mortgage scores are, I'll put a link above to a video that goes into more detail on that. Now, I hope all of this has been helpful, but the very best, single best advice I can give to you if you're thinking about a home purchase is to reach out to a lender. Even if you're not quite ready to buy, even if you don't think you're going to buy for the next 6 or 12 months or more, I help folks plan for purchases 6, 12, 24 months in advance. And if you're already looking at houses online, if you're already on Zillow, trolling around a little bit, looking at Redfin, the right time to reach out is yesterday. It's actually now, because the right house could pop up tomorrow at any moment this evening when you're looking at your phone and throw you into scramble mode. You could be rushing around to apply for a loan without the time that you should take to consider your options, to strategize, or to be in any way, shape, or form methodical about learning about your mortgage options and selecting the right mortgage option for you. So it is infinitely better to explore your options early, even earlier than it feels like you should, and map out a plan that you can just pick up and execute whenever you're ready, whenever the time feels right, whenever the right house pops up. I work with home buyers in all 50 states, and I would love to talk. I really appreciate your time watching this video. I hope you picked up a couple of useful nuggets. If you did, maybe comment below, and don't forget to like and subscribe. Thanks so much.